Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you today.
The stock markets, after about 7 weeks of losses, have bounced back. The big question, is this a permanent bounce back, or are we just being teased with another major correction just around the corner?
Well, I think it's just a temporary thing. That doesn't mean there aren't some things worth buying, but as far as the overall market, you know, we saw the market, the Dow, fall 7 weeks in a row, and then finally it had an up week last week. And from what I saw on CNBC and in the financial media and even on Twitter, just about everybody, including stock market bears, got bullish on the market, expecting big gains to come. We had a big rally day Friday, and then this week the market did dip Wednesday, but it's up as we're speaking today on Thursday. And I mean, I even saw Jim Cramer, I believe it was, say this is a new bull market. I don't believe that at all. You know, in fact, if you go look at the market in March, there was a much stronger rally then than we're seeing now. And first of all, one problem there is in the financial markets and talking about them is everyone is driven by the short-term price action, and reporting typically consists of explaining why the market moved the way it did on any given day, because that daily action is the news. It's what is on people's minds, but most of the time there isn't anything really important happening on any given day. The market moves up or down. Doesn't really mean anything. What's important is putting these moves in context with the larger trends. And the way I define a bear market is a market trading below its 150-day and 200-day moving averages. And when it does that, those moving averages tend to act as resistance. And in the last two bear markets, the one that, you know, was associated with the 2008 crash and the one with the tech bubble that peaked in 2000, you know, the market stayed below those moving averages for 2 to 3 years. With gold stocks, they had a horrible bear market starting around 2012, and it stayed below those 200-day moving averages really till 2016. That was 4 years. And now we're below those moving averages. We're even below the 50-day moving average. And the S&P, even though it's had this rally of almost 3,000 points in 10 days, isn't even above the 50-day moving average. And now it's going sideways. And to me, this is a bounce people really, I think, should use to lighten up on their positions, raise cash reserves, and so forth. And I don't really know how much more upside there is. I would suspect we'll see the market go sideways a week or two and then make another move, and it could easily be, you know, the start of another big downtrend. If not, then you're just looking for maybe 100-point more move on the S&P up to the 50-day moving average. You know, to me, trying to buy in hopes of that is like flipping a coin, And it's very difficult for people to make money, trading the S&P 500 and most of these popular stocks that are in bear markets. When you try to buy bear market rallies, which this is what it is, to make money, you got to get out basically perfectly before things roll over again. And it's just as hard to try to do that as it is to try to short stocks during a bull market. No one, you want to buy dips in a bull market, and in a bear market, you want to lighten up on the rallies or use the rallies to short if you're an aggressive trader. I'm not recommending people necessarily do that. If you want to make money, then I think the thing to do is just forget about the S&P 500. Forget about the ARK ETF or meme stocks like GameStop, for example. Anything trading below that's been, down 20% this year that was once popular a year ago, that still makes up much of the top 100 Robinhood, most widely owned holdings. People are stuck in the past for the most part, that are active traders in the United States playing the same silly stocks that were popular over a year ago. When what they need to be doing is doing something very simple. Instead of thinking about, I'm going to buy a meme stock or a crypto coin and try to get rich quick, which is, I think, what people are being sold on, that idea a year ago, and it's not reality, it's not working, obviously. People would see in advertisements and just people showing, I own a crypto coin, it went up 1,000%, or this stock went up 1,000%, implying that all you need to do is buy the next big thing. That's not reality. That's like turning the stock market into a lottery game, and you just can't, put all your money in something like some coin or crypto coin or stock and hit it rich. It's just, that's not really how this works. The way to win is very simple. You think about not trying to get rich overnight, but simply beating the performance of the S&P 500. That's what a professional money manager aims to do. Just beat the performance of the S&P 500, and you're going to do really well over the long run and make the kind of money everyone dreams about. Well, how do you do that? It's real simple. Just buy and hold things beating the S&P 500. And what's doing that is obviously commodities, oil, energy stocks, and even gold and silver are beating the performance of the S&P 500 this year. I know gold has pulled back. It rallied in April, touched $2,000 an ounce, and briefly went below $1,800 last month, and now it's around $1,850. But even on that, during that pullback, it was still beating the performance of the S&P 500 year to date. Gold was up on the year to date about 2%. Near when it was at the lows of that pullback, while the stock market S&P 500 was down about close to 20%. So if you want to beat the S&P 500, think about things like gold and commodities. And that's the winning play, I think, not just for this year, but in the years to come. And part of the reason is the underlying fundamentals that are driving these price trends that I'm speaking of.
We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, oil inventories in the U.S. Down a lot further than they thought would happen. Despite high gasoline prices, it doesn't seem people are cutting back on their driving.
No, they're not. People still, they're going to take their vacations, they're going to drive, and there's a lot of people still have some extra cash that they've accumulated, after the 2020 payouts. I mean, a lot of people are living paycheck to paycheck, but a good portion of the population, retired folks, still have the money to travel, go to the beach or whatever. They may be traveling smaller amounts to distances for their vacations, but they're still gonna do something. But I think ultimately it will put a damper on travel. It's probably putting a damper on the retail sales figures, and Walmart and Target both warned on their consumer spending, and their stocks had big declines last month. The Target fell like 20% in a single day. So I think what people are doing is cutting, finding ways to budget for their vacations and travels. They're not stopping that, but they may be, buying less at the store. So I think that's the story there. But, I think we have this underlying inflationary problem now, in the world economy and in the United States, that isn't going to end ultimately until interest rates are taken above the rate of inflation, which it means we got a long ways to go before that happens. In the 1970s, the inflation of that decade really started in the 60s, around 1968, and it took over 10 years for the Federal Reserve to raise interest rates high enough to end inflation. The Paul Volcker came in and did that 79, 1980. It took over 10 years. And I think it could take another 10 years before interest rates are taken that high. Instead, what we're being delivered in the financial news and by stock market commentators and people that I think are deluding themselves because they want the stock market to go up is predictions constantly that inflation is just going to vanish overnight. So the implication they're trying to believe is that interest rates don't have to go up that much. They can just go up a little bit and inflation will vanish and the stock market will be okay and it'll just be magic time again, like we have seen up until this year. The previous decades were decades of low inflation, and so the stock market would decline, the Fed would lower rates or do quantitative easing and just stimulate things and make them shoot up. But now the Fed can't do that like they did in the past because inflation is real. People don't want to believe that. They don't want to admit that to themselves. So what they're doing is just saying, it's going to go away. It's going to go away. Well, we've heard these predictions over and over again, in the past 16 months, and none of them have come true. Kathy Wood predicted that multiple times and still does it, but it wasn't just her. It was many people in the financial news and also government officials. Jerome Powell was saying that. Janet Yellen was saying that. The Biden administration was saying that last year. And now finally, Janet Yellen came out this week and said she was wrong. And reality is, anyone could have figured that out because history shows that inflation just doesn't vanish by itself when it gets this high. It takes interest rates going up above the rate of inflation. And, one of the things that's been driving the recent rally are these type of crazy predictions. And there have been people out there saying that, the Fed's just going to raise rates a few more times and they're not going to do it in September. So buy stocks and because of that and jump on. Well, that's nonsense because what the Federal Reserve tends to do is follow the 10-year Treasury yield, and it's above 2%. So they're way behind the curve just on that. We just got so many more rate hikes to go before this all ends. Doesn't mean there will ultimately be periods in which the Federal Reserve, pauses between meetings or between rate hikes. I think that will happen, but I don't think it will happen until the stock market is much lower than it is at the moment. And there are signs in economic statistics that we're in a recession, that justifies them slowing down. And, I don't know when that's going to happen. We could even be in a recession now, though. The first quarter GDP numbers were negative 1.3%. And if this quarter is negative, that would be an official recession. It's 2 negative quarters that makes a recession. And also, in the futures market, there's contracts that trade real estate months out in the future, and they basically are projecting what real estate prices are going to do, and those futures contracts are projecting that real estate prices nationally in the United States will dip slightly into the first quarter next year, and then resume going up. Well, that implies a weak, small recessionary environment that would come to an end, next year in the second quarter. So I think that's not a reason to be bullish on the stock market either.
Mm-hmm. Now, crude prices are high. Are these going to continue to be high prices as long as the Ukraine-Russia conflict is underway and Europe is trying to wean itself off Russian energy?
I think so. I mean, if you look at energy prices, I mean, it's amazing where they are, and people are starting to get used to it. But goodness, before 2020, Saudi Arabia in some of their documents their government would put out about the energy markets were saying they wanted to see oil trade between $40 and $70. That in the long run they thought below 70 keeps the consumer demand strong, and above 40 makes them a lot of money. And now we're at close to 120. And then last year, oil did get up to 70. That's about where it was 12 months ago. It ticked up to 80, but it was it pulled back after it did that, back below 70. So we kind of got into that range that the Saudis, say they wanted last year, and broke out of it this year. The problem with, when you get ranges that, go on for a year, then you break out to the upside, that former resistance point can often turn into support. So, there probably will be a pullback in the price of oil. Yeah, at some point. I mean, this Ukraine war isn't going to go on forever. It may not end this year, but I don't think it's, maybe it ends next year. With, a truce or something. But it will end one day. When it does, there probably will be a pullback in the price of oil. But that pullback might just be back down to 70 or to 80. It's not going to go down to 40 or 20 or something like that. So it's, we are in a different environment with the energy markets than we were until this year. But that's what happens in a bull market, that accelerates. The oil made a secular low, in 2020 when the futures contracts went negative. And at the same time, agriculture commodities did the same thing. And now we're basically 2 years into that bull market, and as bull markets go on, you get higher and higher prices. But that was a secular bottom, meaning not just something that's, a 1 year bull market, but one that can last for 10 years, a decade long. Whereas the stock market was just a cyclical bull market that ended and is now in a bear market. So different cycles, and I think what people need to do is align themselves with those time frames and cycles when they look at these charts and so forth. So like with oil, what that would mean is whenever there is a dip in the oil market down to 80 or 70, it's time to buy the energy stocks. So that's, I already own them. So I'm not looking to sell because I bought them in 2020, my timing was at the start of a bull market, so I can hold, if Exxon pulls back 20%. I don't really care about it. So when you get in, has a big determiner of how long you can hold, or your time frame, or can you ride out a correction? I can in the energy market because I'm in from low prices. But if I were to just jump in the S&P 500 today, I'm turning myself into a day trader because you're playing very short-term trends, and more people are basically doing that, turning themselves into day traders this year. And I'm trying to encourage them to get out of doing that by abandoning the S&P and tech stocks and looking at gold, silver, commodities and energy. I like energy, but I think there's a better buy point here in the mining stocks and in gold and silver.
Mike, thank you so much for chatting with us.
Thank you. Great to talk as always.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our guests, you can send them to info@HowStreet.com, and we'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.